Everyone talks about Warren Buffett's investment philosophy, right? It sounds so simple, but how do you actually use it? Like in the real world? Well, that's exactly what we're going to do today. We're going to pull back the curtain and we're going to walk through his entire framework step by step using a real company, the healthcare giant Abbott Laboratories.
All right, so let's get right into it. Believe it or not, the entire Buffett method really just boils down to this one single question. This is the North Star for every single investment decision he makes. Now, it sounds simple, I know, but finding the answer, well, that requires a really disciplined process. And that's exactly what we're going to break down together. So here's our game plan. First, we'll look at Buffett's four-step framework. Then we'll dive into each step one by one. The moat, the management, the financials, and finally, the price. And for each one, we'll apply it directly to Abbott Labs before we come up with our final verdict. It's basically a step-by-step guide to thinking like a world-class investor.
All right, Buffett's four-step framework. You can think of it as part art and part science when it comes to picking stocks. At its core, it's really just a checklist. You've got the art of really understanding a business, and then you've got the science of digging into the numbers. It's an incredibly powerful way to filter out all the noise. So here are the four big hurdles that any company has to clear to get Buffett's attention. First up, the business itself. Does it have a moat? We'll get to that. Second, the management. Do you trust the people at the top? Third, the financials. Do the numbers actually back up the story? And finally, step 4, the valuation. What's the right price to pay? So let's use Abbott Labs to really dig into each one.
Okay, step 1, the moat. Does the company have a durable competitive advantage? Now, this moat idea is probably Buffett's most famous metaphor. Think of a castle, right? The moat protects it from invaders. In business, it's what protects a company's profits from competitors. A wide, deep moat is everything. It's literally the first thing Buffett looks for.
So, the big question is, does Abbott Labs have one of these wide moats? Oh yeah, for sure. It's built on a few really solid pillars. You've got incredible brand power and trust from doctors and patients. Then there's the whole regulatory and patent protection thing. That's a huge barrier. And think about it. For a hospital using their systems, the cost and hassle to switch to a competitor are just massive. All of this adds up to one thing: real demonstrable pricing power.
You know, sometimes a single product can tell the whole story. Take Abbott's Freestyle Libre. It's a continuous glucose monitor, and it's a perfect example of their moat in action. The brand is trusted, it's got layers of patent protection, and once a patient starts using it and gets into that ecosystem, they're just not going to switch. It's a fantastic, real-world example of how a powerful moat actually works.
All right, on to step 2, the management. Is the leadership honest, rational, and shareholder-friendly? This is so important. You can have the best business in the world, but bad management can just destroy it. So Buffett asks a simple question. Are the folks in charge good stewards of my money? He's looking for leaders who are honest, rational, and act like they actually own the place.
So how does Abbott's leadership stack up? Well, they score really high marks here. We're talking about a team with a long-standing, rock-solid reputation. They've got a great track record of making smart decisions with capital, whether it's pouring money into R&D or making smart acquisitions. And maybe most importantly, they're super disciplined. They stay focused on what they do best, and they have a huge commitment to getting cash back into the hands of shareholders.
And if you want proof, look no further than this. 50 plus, that's how many consecutive years Abbott has increased its dividend. Think about that. That makes them a dividend aristocrat. And this isn't just some number on a page, okay? It's a powerful signal from the management team. It's them saying, look, we run an incredibly durable, profitable business, and we are absolutely committed to sharing those profits directly with you, the owners.
Okay, now for step 3, the financials. Do the numbers actually prove it's a superior business? So far, we've been talking about the art of this, right? The qualitative stuff. But now, we've got to pivot to the science. Because a great story about a company's moat and its awesome management team means absolutely nothing if the numbers don't back it up. So, let's dive in. So, Buffett has a few key metrics he always looks at. First, return on equity. He's looking for something consistently above, say, 15 to 20%. And yep, Abbott consistently hits that mark. Next, debt to equity. He wants to see that below 1.0, which means they aren't overloaded with debt. Abbott, well managed, right around there. Then you've got profit margins. You want them high and stable. Check. And the big one, free cash flow. He wants to see it strong and growing. And for Abbott, it's been the engine of value for years. So, the homework checks out. The numbers absolutely confirm the story.
You know, let's just pause for a second on that last one, free cash flow, because it is so important. What is it?
Well, in the simplest terms, it's the actual cash a company generates after it's paid for everything it needs to run and grow the business. Buffett calls it the true owner's earnings because it's the pile of cash that can actually be used to reward the owners, the shareholders.
And this is really the key takeaway here. A wonderful company is not a great investment without proof in the numbers. See, analyzing the moat and management, that gets you interested. It gets you to the front door. But it's the financial strength, the proof in the numbers, that actually lets you inside. You have to verify the story with cold, hard facts.
All right, last but certainly not least, step 4, the price. Can you buy it for less than it's truly worth? Okay, so let's say we've done it. We found a wonderful company, it's got great management, the financials are rock solid, but here's the thing. This is where so many people mess up. The final, and you could argue the most important step, is figuring out the right price to pay. Because even the best company in the world can be a terrible investment if you overpay for it.
So how do you avoid overpaying? Well, Buffett uses his other famous concept, the margin of safety. The idea is actually pretty simple. You do all your homework to figure out what a company is really worth, its intrinsic value, and then you insist on buying it for a whole lot less than that number. That discount, that gap, is your margin of safety. It's your protection in case you're wrong, or if just bad luck strikes.
Let's make this super concrete with an example. Okay, so after all your research, you calculate that a company's true intrinsic value is, let's say, $120 per share. That's your best guess of what it's really worth.
But are you going to pay $120? No way. You're a disciplined investor. You need a margin of safety. So you decide you want a 20% discount just to be safe. Well, 20% off of $120 is $24, which brings you to your disciplined buy price of $96. That's your line in the sand. You've done the work, and now you just patiently wait until the market offers you that price, not a penny more. That is the essence of value investing.
All right, so let's put it all together for Abbott Labs and come up with our final verdict. We've walked through all 4 steps, right? We've seen that Abbott has a strong moat, great management, and solid financials. We also know how to think about the price. So what's the call?
This really brings it all into focus. On one side, you have the wonderful company part. The business moat? Check. The management? Double check. Abbott absolutely clears those hurdles. But then you have the fair price question. The financial strength is there, we've seen that, but the big question mark, the one that matters right now, is the margin of safety. Is today's price giving us that discount we need?
So what's the verdict here? What's the final call on Abbott? Well, the strict Buffett framework demands patience. The business is fantastic, no doubt about it, but the verdict for a new investment today would be wait. You should only pull the trigger, you should only buy, once your own financial and valuation work confirms that the stock is trading at a meaningful discount. Sometimes the hardest part is just waiting for the right price.
And honestly, that's probably the biggest lesson of all. The goal isn't just to find great companies, it's to learn the discipline to wait for a great price. This whole process, it isn't about getting a hot stock tip. It's about building a mental framework, a way of thinking, and then having the emotional discipline to sit and wait for that perfect pitch. That is the real secret to success in the long run.
So there you have it. You have the framework, a 4-step checklist to guide you. You know what to look for in the business, the management, the numbers, and the price. So the only question left is, what's the first company you're going to analyze?